Global public sector entities manage trillions of dollars in assets, from sprawling economic infrastructure to complex sovereign debt. Measuring resources at this scale requires purpose-built tools. The metrics used to evaluate private corporations do not translate to the scale of a nation-state. Private sector accounting is engineered to measure a single outcome, the generation of a return on equity for investors. A government's mandate is different. Its primary objective is the delivery of services to the public. This difference in purpose creates a significant blind spot for professionals trained exclusively in corporate reporting. Attempting to force sovereign operations into a profit-seeking framework distorts the financial reality of the entity. The International Public Sector Accounting Standards Board, or IPSASB, addresses this gap. They develop the specific accounting architecture required by public sector entities. The IPSASB conceptual framework establishes the concepts that underpin this reporting system. It serves as the definitive guide, determining how transactions and activities are recognized and measured. This framework discards the pursuit of equity returns. It replaces the profit motive with two specific goals: accountability and sovereign sustainability. The primary mechanism used to deliver this data is the General Purpose Financial Report, or GPFR. This comparison shows the structural shift. While a corporate annual report has a narrow focus, the GPFR expands the reporting boundary to capture a much wider scope of operational reality. To accurately assess public sector finances, the reporting model must be built from first principles, engineered specifically for entities that operate without a profit motive. Every reporting framework starts by identifying the primary user consuming the data. A corporate framework prioritizes the investor. However, the public sector lacks traditional shareholders holding equity. The IPSASB identifies two primary user groups instead. The first is service recipients, the citizens and residents who depend on the state for necessary programs and infrastructure. The second group is resource providers. This includes the taxpayers, donors, and lenders who supply the capital required to run the government. This user matrix maps the relationship these groups have with the state. Resources flow inward from the providers to fund operations, while services flow outward from the state to the recipients. Because citizens and taxpayers lack the authority to demand bespoke internal financial data, they must rely entirely on these standardized reports to monitor how resources are managed. This dependency creates the GPFR's dual mandate. It must provide information for accountability, justifying past resource management, and for decision-making, informing future voter and donor allocations. Since taxpayers cannot execute their own internal audits, the GPFR is engineered as their primary tool for sovereign oversight. The framework must also account for a specific financial mechanism, the non-exchange transaction. In a standard corporate exchange transaction, there is a direct transfer of equal value. A customer pays a price and receives a product of approximately equal worth. A non-exchange transaction functions differently. Taxation pools compulsory resources into a central reservoir without guaranteeing a direct proportional return to the individual taxpayer. The state then distributes services from this reservoir based on public need, completely untethering the individual cost from the individual benefit. This asymmetry severs the traditional accounting link between revenue generation and operational performance. Because of this disconnect, standard metrics, like a budget surplus, are incomplete indicators of success. They show that revenue exceeded expenditure, but offer no data on whether the government's service delivery objectives were met. When revenue is legally divorced from performance, the framework must look beyond cash flow to measure actual impact. This logic changes how we view the balance sheet. Governments hold property, plant, and equipment primarily for their service potential, rather than their ability to generate cash. Many public assets are highly specialized and lack secondary markets. This makes traditional cash flow valuations impossible to calculate. Military assets represent massive capital investments that generate zero cash, yet they provide the essential service of national security. Common infrastructure like roads must be measured by their public utility and the ongoing liability of their maintenance, rather than an assumed resale value. Because public assets consume resources for the public good rather than generating profit, standard balance sheet valuations fall short of the operational reality. This brings us to a common professional misconception: the idea that a GPFR is just another name for traditional financial statements. The IPSASB defines financial statements as only the core of a much wider, more comprehensive reporting boundary. This modular blueprint starts with a central block of traditional financial statements, covering financial position, performance, and cash flows. We then integrate the first expansion module, budgetary compliance. Because governments operate on strict constitutional spending mandates, the GPFR must demonstrate exact adherence to the approved budget. The second expansion is service delivery achievements. Without a profit motive, non-financial quantitative measures, like outcomes and outputs, are the only way to assess whether a government is operating efficiently. The final layer is prospective financial information. Sovereign commitments span decades. The GPFR uses long-term capacity modeling to ensure current programs don't jeopardize the financial stability of future generations of taxpayers. The resulting GPFR is a multidimensional dashboard designed to capture the full scope of sovereign operational reality. Expanding the reporting boundary introduces a technical challenge, applying financial rigor to non-financial and prospective data. To be useful, the IPSASB requires faithful representation. Information must be complete, neutral, and free from material error. Neutrality is supported by the exercise of prudence. Prudence requires caution when making judgments under conditions of uncertainty. This prevents the systematic overstatement of assets or the dangerous understatement of long-term liabilities. But how do auditors verify a demographic forecast or a qualitative service outcome? The framework addresses this through indirect verification. Instead of directly observing an outcome, auditors verify the inputs, assumptions, and methodologies used to compile the data. As the reporting scope expands, this evolution in verification methods maintains public trust in the state's financial data. A truly functioning sovereign state relies on critical infrastructure and long-term planning that outlasts any single political administration. The IPSASB conceptual framework proves that public sector accounting is a distinct architectural philosophy, not just a modified corporate standard. Expanding the GPFR boundary beyond basic financial statements is the only way to accurately capture the reality of non-exchange transactions. This framework equips citizens and legislators with the data required to enforce true accountability. Ultimately, public sector financial reporting is the science of quantifying the enduring sustainability of the state and its obligations to its citizens.